Welcome to another video about macroeconomics. Today we're going to talk about bank runs. So we already discussed the way fractional reserve banking system works. And essentially we said banks borrow money short-term from their depositors and then turn around and give long-term loans to investment, to firms who want to do investment, to people who want to buy houses and so on. And so the bank is providing liquidity, but at the same time, the bank has a problem because its liabilities are short-term. Depositors can show up anytime to ask for their money, and its assets are long-term. And so normally the bank just keeps reserves, keeps a fraction of those debts, of those deposits as reserve, and people carrying out their transactions, they only take out enough money to carry out their daily transactions. The bank has a good idea of that, and so the system works smoothly. However, every now and then there is some situation where, for whatever reason, the depositors may start worrying about whether the bank is going to be able to pay them back. And so that creates a little bit of a psychological situation where everybody starts to panic, because it's kind of like a game of musical chairs. We know the bank only has a fraction of what it owes sitting in reserve. So let's say the bank has 10% of reserves. Only the first 10%, first people who come to get their deposits out of the bank will get paid. The rest will not get paid. And so every time people are just going to the bank, rushing there to take their money out, that's going to make the bank go bankrupt. And that's what we call a bank run, because everybody runs to the bank to get their money out. Whoever gets there first get their money. Whoever doesn't loses. Now, what is the problem with bank runs is that, as we saw, any bank is vulnerable to a bank run. Okay, so it could be that a bank run, for example, there was a Silicon Valley bank run that happened a few years ago. Essentially, what happened is the bank had a bunch of poorly chosen assets, and when interest rates started to go up, people started to look at the assets that the bank had, and they said, this bank has assets that are not really good, so I better take my money out. So that was an example of a bank. The actual story is a little bit more complex, but essentially, that was an example of a bank that was not solvent, that its portfolio of assets was not necessarily composed of good assets. And so, in some sense, we can argue, okay, that bank going bankrupt may be a good thing, because it's a natural process of the market that people who don't do things well get punished and people who do things well get rewarded. And so this bank didn't invest well, it should go bankrupt. Now, there's a few problems with that. The first problem is obviously all the people who lend money to the bank are going to be losing everything. But you may argue that's also part of the way things work in a capitalist society. You give a loan, you're taking a risk. The most important thing to understand about the bank run is that they're contagious. So the Silicon Valley Bank was not a solvent bank because it had given out bad loans or because it had invested in bad assets. But anybody else who has money in their bank now all of a sudden can start saying, oh, I have money in JP Morgan or in Citibank or BMO. Those are good banks with good assets, but I don't care about that. I don't even know what assets my bank has. I'm just going to take my money out just in case because I see the other banks are going down. And what that will do is make the whole bank collapse, even if it's a solvent bank with solid loan portfolio. And obviously that can create a huge problem for the economy, because if a tomato juice factory goes down, then it just affects mostly people who drink tomato juice and people who work in the factory. It may create some ripples, but the ripples are relatively small. But for all the reasons that we have discussed, the banks play a fundamental role in the economy. In particular, they issue liquidity and they issue credit. And so if the bank starts to collapse and nobody lends money anymore, that can lead to a disaster for the whole economy, not just for the banking sector. And so for that reason, bank runs are always seen as a very negative consequence that can have very serious implications based solely on a panic. Okay, so the important point there is that the sound banks will also go down if the fear spreads wide enough. Okay, it's like shouting fire in a theater. even if there was no fire, or even if there was a small fire, a lot of people can get hurt for no reason. Why is it that we don't see bank runs so often? Is because we have deposit insurance. What is deposit insurance? It says the bank takes insurance against bank run and says, I'm going to pay an insurance company so that if I go bankrupt, the insurance company will pay the depositors. What does that do? Why is that so important? Because now as a depositor, I know my money will be insured. So even if the bank goes bankrupt, I still get paid. So that now I don't have an incentive to run to the bank like a psycho. I'm like, well, if I don't get paid by the bank, I get paid by the insurance. And that takes away the incentive to run to the bank to take your money out. If nobody runs to the bank to take the money out, the bank does not end up needing the insurance. So it's one. Now, obviously, insuring all of the deposits is too expensive. So typically, banks only insure up to a certain amount. In Canada, it's $100,000. In the US, it's a little bit higher, I believe. But essentially, deposit insurance keeps bank runs from happening, although not entirely. An example of this was the Silicon Valley Bank, where a lot of the depositors in Silicon Valley Bank were companies which typically had accounts which were much larger than what is insured. And so this insurance didn't quite really work in that context. And there are other examples of modern bank runs that don't necessarily happen between customers and the bank, but happen in kind of secondary markets. So this principle of bank run has not fully gone away, even though we may have some deposit insurance. There are other forms of bank regulation that are designed to eliminate this problem by essentially having capital requirement, forcing banks to have more assets, or having higher reserve requirement, and so on and so forth. And then finally, there's also the central bank acting as a lender of last resort, which means if I see a bank is going down, and if I see that bank is going down because of made poor decisions, then we may let that bank go down. But at the same time, if we see a bank that is solvent, which has good long-run assets, that is going bankrupt because people are just panicking, the central bank may step in and give a loan to that bank to pay the depositors, because it knows in the long run the bank is solvent and is going to be able to pay back. So the central bank sometimes acts as a lender of last resort. When the bank doesn't know what else to do, turns to the central bank will bail out the bank if it thinks the bank it's a solid bank. Now, that creates a problem because at the same time it can lead to what economists call moral hazard. Because now if I'm a banker and I know that if I run into a problem, the central bank is going to save me, that leads me to the incentive of taking way too much risk. Because now if the risk pays out, I make a lot of money. If the risk doesn't pay out and I go bankrupt, the central bank is going to bail me out. So by acting as a lender of last resort, the central bank can create too much incentive for banks to take too much risk. So the central bank has to balance those two things carefully. So anyway, that's the basics about bank runs. Thanks for watching.